Deciding what to do with a stock you already own is a uniquely stressful experience. You stare at the screen, paralyzed by the options. Do you sell to lock in a massive profit? Cut your losses on a steep drop before the damage deepens? Or finally dump the company that has spent 2 years moving entirely sideways? These choices rely on the psychological phenomenon of anchoring bias, the tendency to tie future decisions to an arbitrary piece of history, the price you paid to acquire the shares. Warren Buffett approaches the problem from a different angle. The stock has absolutely no idea that you own it. It doesn't remember what you paid, and it doesn't care whether your personal account is up or down. Look at this asset trading at $50. One investor paid $100, feeling like a failure. The other paid $10, feeling like a genius. But if you strip away the purchase history, both are looking at the exact same asset. The future cash flows of that business will not change to validate the anxiety of the first investor or the confidence of the second. Because your entry point has zero mathematical impact on tomorrow's returns, you have to discard it. To justify selling an asset, you must adopt filters that look strictly at the future. In 1959, Buffett was managing his partnership and bought shares in a bank called Commonwealth Trust. He acquired the stock for roughly $50 a share and eventually watched the market price climb to $80. This comparison illustrates the changing math. When he made the initial purchase, Buffett calculated the true value of the business was around $125. By the time the stock hit $80, the business had grown, pushing its actual value to about $135. The gap between price and value was closing, but it was still a cheap stock. He didn't sell because Commonwealth became a poor investment. He sold because he found the Sanborn Map Company. Sanborn offered a significantly wider gap between what the market was charging and what the underlying business was worth. This is the logic of opportunity cost. Every dollar left parked in a perfectly adequate business is a dollar that cannot be deployed into an exceptional one. You don't hit the sell button simply to realize a gain. You sell when your capital can work harder in a mathematically superior vehicle. Investors often confuse a volatile market with a broken business. A missed earnings target, a sudden recession, or a scary news cycle does not damage the long-term economics of a company. A true exit signal only flashes when the specific competitive advantage that attracted you is destroyed. Consider Berkshire Hathaway's massive holdings in the major U.S. airlines prior to 2020. When global travel collapsed, the entire industry was grounded almost overnight. As those planes sat empty on the tarmac, the airlines took on massive debt and faced a different economic reality. The underlying math of the industry completely broke down. Buffett assessed the massive damage and sold off Berkshire's airline positions entirely. The same logic dictates when to sell due to slow technological decay. Buffett held the Washington Post for decades because it operated as a lucrative local advertising monopoly. But as the internet arrived and steadily siphoned away those ad revenues, that moat dried up, eventually forcing him to exit the position. The trigger is highly objective. The moment the trait making the business profitable ceases to exist in the real world, the stock must leave your portfolio. Buffett often repeats his preference to hold great businesses forever, leading many people to assume he ignores basic risk management. But when managing massive, sprawling pools of capital, a soaring stock can create a very dangerous structural flaw in the portfolio. In the 1960s, his partnership bought heavily into American Express. The underlying economics were pristine, and the position compounded immensely. But success created an extreme vulnerability. Looking at his portfolio distribution, you can see the scale of the risk. The stock compounded so rapidly that it ballooned to represent roughly 40% of his entire partnership assets. Nearly half of the firm's total wealth was tied directly to the fate of a single corporation. Trimming a massively successful winner is often a mechanical necessity. Reducing a dominant position ensures that your entire financial survival doesn't rely on one executive team executing perfectly for 10 straight years. To allocate capital logically, you have to sever the emotional tie to your original entry point. Your past purchase price is history, and your portfolio only exists in the present moment. This leaves you with one effective question to stress test your holdings. If I didn't already own this stock, would I still want to buy it today? If the answer is yes, if you haven't found a better place for the money, the business model remains intact, and your position size is safe, then the most profitable move is often the most difficult. You do absolutely nothing. No rebalancing, no selling to secure a psychological win, and no panic. Just the quiet ownership of a compounding asset. Generating lasting wealth requires intense patience. You ignore the noise, sit still, and only intervene when the mathematical reality of the business forces your hand.